I'm going to assume that we're live because every week it has a little bit of a delay, but welcome back, Justin. Appreciate you jumping on every single week, even when you're out and about. It seems like you're back in Seattle now, but today is tax day. So, what do you want to talk about?
Oh man, April 15th, everyone associates that with tax days. Now, me being an investor, yes, it's related to tax day, but I usually defer the 6 months until October 15th. But I think it's a great idea to talk about taxes for people who are just getting started, and then people, like both of us where, we've had hundreds of units to manage. So it's definitely a problem that people grow into at some point, and so thought we should talk about it.
Cool. Yeah, well, I'm doing mine. I didn't want to. My wife wanted to file on time, and I put a wrench in that. Seems like it always happens. Some of
Hmm.
the partnerships that we split up are taking longer. Some of the partnerships that are running are taking longer. And so we're trying to systematize it so that next year can be the first year that I get it done on time.
Well, if you're self-managing, it is possible. And if you're not doing any partnerships, it is possible. So, I mean, maybe that's a good, we can start here. And so for me, most people are like, what, you don't file your taxes on April 15th? Most people don't know that you can file an extension and it's a 6 month. If I remember right, I believe it's business and then personal. So like March 15th, it's supposed to be business, April 15th, personal. You just delay everything 6 months. So September would be business and then October would be personal. So, and the reason why started shifting away way back, gosh, I don't know how long I've been doing this, probably 6, 7 years now, is that when I started doing partnerships, and I'm not always the one doing the taxes. So, and when you have a partnership, you get what's called a K1. It's like your portion of that business income that comes to you. So if you're in multiple partnerships and those partnerships don't end up doing their taxes till after April 15th, there's no way that you can do your personal ones because you have to have all your businesses then come to you personally, right? So that's, for people that are wondering like, why would you not do it on time? That's like the number one reason is that you have other people involved that do not have the same timelines.
Yeah. Oh, yeah, for sure. Let my dog out so he doesn't bark at me.
Wait, who let the dogs out?
That's me.
It's just
Yeah.
you and me on the live stream, so I'd laugh at my own jokes.
It's the best way to do it.
I
Someday when
know.
you're like super viral and famous,
Yeah, I
start
know,
getting,
right? Flavio's on. Maybe he heard it.
oh, there we go. Flavio's working on a 16 unit.
Oh,
2.3 million, seller finance, 5% interest for 30 years, 10% down. And he's like, I don't know if this is a good deal. I'm like, if you don't buy it, send it to me.
yeah. I
So
mean,
what do you do to just simplify your taxes though? Like what software are you using?
mhm.
What are you doing there?
So I think I'll talk about the evolution because when you're starting out in investing, you don't know what you don't know.
Right?
And say that again.
Yeah,
Yeah.
absolutely.
So when I very first started, it was a house hack. It was just a duplex. I was living in one and then renting the other one out. And I was just kind of tracking everything in Excel, looking at bank statements, fairly easy if you only have a couple extra transactions every month, right? You have your expenses and mortgage and like utilities, and then you're getting the income from that one unit. So easy, right? You could probably do your taxes on your own and just do TurboTax or whatever, you know, software is out there, right? H&R Block, whatnot. So then what ends up happening if you're like Cody and I, we're like,
Yeah.
well, if one's good, two's better. If two's better, ten's amazing, right? So we start progressively adding more properties, and then there's more bank accounts and there's more transactions, and then it's like, wow, I don't think I can manage all this in Excel. And what ends up happening is the people that you're working with may not be able to grow with you. So, when you're doing taxes at the beginning, there's like 10 boxes to fill out. As you start adding more and more of these properties and partnerships, there's a ton of forms that become complicated. So then you go to a new tax person because if you're going to Liberty Tax or H&R Block, those people are trained on the 80+% of the population that have one job, and they can literally file the taxes in like under 30 minutes. So what ends up happening is you progress your systems, you progress the people that you got to work with. So I'm looking back, I'm on my at least fourth person. I had H&R Block, then I had a realtor or a real estate specific person that's well known in this area. And then I went to like a mega company in Utah because I was like, why don't I merge the bookkeeping with the tax? And then they're garbage. But it took so long to get set up. It took a long time to get out. I'm now back at two separate ones, one bookkeeper and one tax advisor. And this is finally the best I've had. And I'm 10 years in, and 9 years of it was painful. And predominantly, like what most people use in terms of systems is QBO, which stands for QuickBooks Online. They have a desktop version, which is just your traditional QuickBooks. And so those are the main two softwares. Now, there's other software that's out there. I believe Stessa does some of that. You can kind of use like Baselane and stuff. Some of these property management softwares can kind of help you. But really, like QuickBooks is like the main one that can ingest all the info, summarize it into uh, balance sheet, income statement, cash flow statement to ultimately get to your taxes.
Sweet. Yeah, I was working in the beginning and I remember first time I filed a tax return, it was with a really prominent individual.
Hmm.
We probably used the same one, but I'm not going to name names because I remember he did my taxes for the first year and he's like, he never asked for a bank statement. He never asked to see anything. He's like, how much do you think you drove? Let's just make some stuff up. You won't get caught. And so I was like, I I don't know if he's doing this because I'm too small, it doesn't matter, or if this is just the norm. So I ended up switching.
It's not the same person I had because I had a female.
Hmm. Okay. Well, the one I've been working with, I mean, really cool guy,
Hmm.
investor, but when you see how they run with small people, it's like I don't know if that's gonna keep going or if that's actually gonna change, but I didn't like how it was being run. I just felt like this is a recipe for disaster.
Right. Yeah, you just brought up another company, so I had five. I forgot about one, but it's an evolution because your business grows and over time, and you have to. That guy that you first met with would not be able to manage what you got today. No, no way. Based on what he's doing, too many of these round assumptions are going to come back and get you. Because like if you ever do get audited, you need to have the goods, meaning the data.
Yeah, the worst number in accounting is a zero, right? Or a rounded number, I should say. You need
Yeah.
everything to zero out. I remember one year I I was brought into my CPA's office and he wanted to teach me some stuff and he's like, "Okay, look at your books. Add up all the transactions and subtract the expenses. Is your starting number, does it add up to the ending number? No." It's like, uh-oh, I see the problem. So yeah, he made us go through a deep dive on that. My old partner Christian and I, we were in that office all day until we made it zero out. It's like zero is the magic number, but rounded numbers are terrible.
Yep.
And it's okay,
Well,
lesson
you
learned.
guys had so many separate, so there's partnerships that you guys had, but then you had different deal structures. So like when you're working, for example, if you guys have a credit card with Bank of America, all the documents are all online. Quick, I could get it all in like a minute, 2 minutes. When you're doing a seller finance offer, how easy is it to get those documents? If it's Just a Joe Schmo. He owns one property. He sold it to you. Is it easy or is it hard to get those documents?
Well, yeah, so I bought some properties from an individual and we would just I'd give him a check every month
Hmm.
or ACH. And I never got an interest statement.
Yep.
And there was a year where it wasn't all reported properly on their end. And so, I had to manually show I paid it and that it was allocated to interest first based on the note. So, yeah, lessons learned. Always on a deal like that, put it in note servicing. So I'm working
Yep.
on some seller finance stuff right now, and it's gonna have to go into note servicing.
Yep. 100%. Because like I have a literally this guy was gosh, he was 83 when I did the note. And I'm 7 years old. He's 90 right now. His wife has since passed. But he's very good. He's very organized, but it's all paper. There is no online thing. It's right. So he mails it to me. He mails me the interest stub. I forget the code for it. But then there's other people that I never hear from. So I then create Google Sheets for all my seller financed that have the amortization table for everything. Because what was happening is that we get to the taxes and they'd be like, well, what are the terms? And if I send them a contract, they're not in the business of interpreting contracts. They being bookkeepers, are in the business of putting numbers in boxes. If you could do anything outside of that, that's not, they're either going to charge you a lot more money or they're going to push you to the bottom in terms of getting it done. So now I have like a master spreadsheet that tracks all the interest rate and the terms, and it's actually part of the contract now, just to make it simple. One, I have an exhibit, goes with it, they sign it, and then we keep that on file. So that kind of gets the workaround. But in a perfect world, yeah, like I just did a lease option. We're running it through just to make sure because this person is concerned about debt to income. We have it going to a third party to make sure that if when he goes to get a new loan, that this third party servicer can then say, hey, all the payments, all the payments into them, all the payments out to the bank, and the balance to the seller. So that's definitely helps if it comes to the person on the DTI, but also when you're finishing your taxes.
What's the biggest lesson you've learned, or maybe the most expensive? Because I
Mhm.
definitely know what my most expensive one was, but I'm curious what yours was.
My most expensive is that I never organized and then scaled. I scaled and then organized. So really what I was good at scaling was inefficiency and scaled a problem, right? So like if you're not doing your books consistently, accurately, and timely, i.e., you have to finish the prior month this month. That to me that's timely. Unless you have like an active person that's literally up to the week. So my biggest thing was I would go a year and then be like, oh, I got to get my tax stuff. And then it was just so painful to get anything done. I then would be pushing it off myself. So that's really the biggest thing is I never got efficient, organized, and structured with the bookkeeping and tax. As I mentioned before, I've had 5 different tax people. Every time you change the amount, when you're changing over multiple properties, multiple states, multiple partnerships to a new company, I mean, I'm talking weeks, if not months, to transition over. So that was my biggest expensive mistake.
Yeah, mine was not knowing in the beginning you can only write off against your basis in a deal. So I did a whole bunch of zero down deals where basically my basis ended up being the few mortgage payments and utility bills I paid throughout the year with the rents. And so I was expecting write-offs because I structured these zero down deals and I ended up not being able to take any of the write-offs. That was like my first year buying stuff with Christian. We were like, oh, we have this income, we're running a PM company, and we were just launching multifamily strategy. And so we had a little bit of earned income at that point. And we were thinking, oh, I can write off against everything. and then ended up getting whacked with an $80,000 tax bill because we couldn't
Yeah.
claim any of it. So that was a big bummer. I
And
wish I had known that earlier on, and maybe there was a way to still even, because I had a real estate professional status, so maybe there was a way to restructure. What I was told by my CPA at the time is said if these seller notes were recourse, then there would have been more benefit for you. But since they were non-recourse, you don't really get to claim it towards your basis. And so, yeah, it's fun working with the professionals now to structure that stuff so that I don't make those expensive mistakes.
when you say, and I'm learning here, because when I'm talking with my tax people, they're doing the calculation of bases and do it for me. So, when you're saying bases, what do you mean by that?
So when I go buy 10plex, if I pay $1 million
Hmm.
and I put 100 grand down and 50,000 into it over the course of the year, like my injection from my end is 150 grand.
Right,
Being super, super like high level rounding everything, which you're not supposed to do, uh, I would be able to write off against the 150
right.
is what
So,
I've been told. Because that's my basis in the deal. And then I haven't had to look into this in years since that one CPA chewed me out. It's like you're rounding your numbers, but there's internal basis and external basis. So we could do a call on the findings from that. I just have to review my notes, but you can write off against one. And what the CPA told me is that I could make it a recourse loan, and then that would, since I'd be signing for that personally, it would allow me to get more write-offs against that amount too. So there's so many ways to do it, but having a professional that knows how to structure it is definitely the key.
so the way you're saying, I'm interpreting what you say for bases. Effectively, it's your cash in year one on the deal. It's kind of what I'm.
And then over time, that increases. Now, the basis of the deal that you're writing off against, of course, goes down. Like eventually you write it down to zero, but that's not what I'm talking about.
Yep.
Like when I was doing these zero down deals, the dilemma that my CPA threw up is you have no money in it. How are you going to write off against no money? And you have no skin in the game. You can't, like the IRS doesn't want to give you this. They want to give it to the other partner who brought the money. So that was the dilemma that I faced. So
Mm.
now when I do a partnership, what I try and do is the other partner writes an equity check for half the money and they lend me half the money so that I'm contributing it. So I still have to pay interest, but interest is cheaper than paying taxes.
That's your workaround.
Yeah, like if I pay a 6% interest rate, I'm not in a 6% tax bracket, right? So it's way cheaper.
Right.
I'd rather get the write-off.
Hmm. I love it, man. Yeah, and then as you get more proficient or analyze more of the tax code. I mean, the tax code's like probably a foot tall, right? And in today's world, because we have accelerated depreciation, bonus depreciation stuff, there is a way to have zero taxes. So like because I'm late. It took me forever. I did my 2024 taxes just recently. So that shows you how late I am. So on those, it was the first time I've ever paid zero taxes. And so I'm like, oh my. But this is the first time I used my new tax advisor. So because of that, we went back and redid 2023. So I think in 2023, because I paid like 10,000. So I think I'm gonna get all that 10,000 back in 2023. So I'm excited to redo 23 and then do 25, because we're taking more use, I shouldn't say take advantage. I'm doing what the tax code wants me to do, and the I'm getting the outcome of that. So,
Well,
I'm
it's an
able,
incentive list, not a penalty list. So like it's do this and we'll give you this, but I'd probably need to go back and rework my 2024 because my 2024 was 40, it was like, well, I think it was 38 grand and I didn't cost seg anything. So I bought a property in 24. I probably should go back and do that.
Yeah, so now let's see. Now, if you do cost seg, I'm not going to get the numbers right, but when Trump in term 45, what was that? 2016 to 2020, I believe, something like that. Well, that's when they was doing the cost seg, they had that where you could do the cost seg, effectively bring a lot of the depreciation forward. Then they had it moonlight, which means that every year, instead of 100%, then it went to 80, then it went to 60, and then it went to 40 or something like that, right? So, and then obviously, he came back into office. So I believe in 2025, he reinstituted to the back to 100%. So in 24, you might have been able to bonus depreciate 40%. So could you use it to get a tax write-off? Yes. But now if you bought that same property from in December versus 24 versus January 25, the acceleration of the depreciation amount is totally different. So the value of that property from a tax reason, just being in a different tax year, is massive. So, and that's literally this year, with the projections of my just the agent side, it will be greater than my carry forward losses. So I could have taxes this year. So then I'm
Oh
like,
my
well,
goodness.
I know. So I'm like, I will probably have to buy something, maybe a couple in Q4 in advance, knowing that, hey, if I buy these properties, I know I can do the accelerated depreciation and use that if I need it.
Yeah, that's crazy. You make a lot of money then.
I don't know about that. I mean, a lot of money. I mean, just like I'm sure you actually have more money probably coming through, right? Because just think, let's say you have 100. When I was at the peak, I think it was like 145 units, and a lot was out of the Washington, so it's around $1,000. So you're like every month, like, and that was just the rental, not the agent. So like 150,000 a month comes in. Like there's a lot of money that comes in, but then there's a lot of money that goes out. So just because a lot of money comes in doesn't mean that you make a lot of money. And
Right.
because it all comes down to, because back to your point of if you borrowed 100% of that money, you may be all that money you actually make, quote unquote, profit, then has to pay the interest, right? So it all comes down to what you actually are netting. That's where you end up paying the money on.
Yeah. There's something else I learned recently. I'm buying a deal, well, that I've been working on forever. And it's a set of sevens
Oh
from
yeah.
an individual. And I mentioned this many times in the past because it's been a long, long journey. But there was a package for 6.6 million, and it's four side by side sevens. And they're doing it seller financed with very little down, like 6% down.
Mhm.
And they brought up and said, well, hey, in Washington state, excise tax, we're talking different taxes now, but excise tax scales. So the bigger the value, the higher the tax, because that's how they get the rich people. And so what we're actually doing is we're splitting it up into four independent sevenplex transactions with the proportionate amount down. And this guy's going to save over $80,000 in excise tax, which is for those who don't have that in their state, sales tax, basically.
Mhm.
He's going to save over 80 grand just by splitting up a big transaction into four. I thought that was pretty cool.
Well, it's not that he's splitting it up into four because the tax is a percent. So if the dollars are the same amount, what's the difference? Is he re
Because they're independent transactions, and in Washington state, there are brackets. So I actually just sent this to him, and this is all public online. I ran the exact deal through my AI platform as well, and there's calculators on the MLS, as you know.
Yep,
But the first $525,000, and I'm just going off of the bracket here, I'm just reading,
yep,
is at 1.1%. The next million's 1.28. The next 1.5 million is at 2.75, and this is in this deal of 6.6 million, and the remaining 3.575 million is at 3%. So if you have four independent transactions,
Right.
there's none that go over that bracket that would ever put it into the 2.75 or 3%. So, you got your local taxes, but if you do it as four deals of 1.65 million instead of one big one, it's 22,000 in excise tax per PSA.
Yep.
So
So
he ends up
now,
saving a ton of money.
yeah.
I thought that was pretty cool.
So there's what you just brought up there is a great topic because like when people hear the word tax, they think of just one type of tax. There's so many taxes. There's sales tax, there's income tax, and then what you just talked about, excise tax, there's property tax. I'm sure there's other taxes, right? So,
Tax.
yeah, exactly. So, because when I was hearing what you're saying, I was thinking of taxes related to income tax. You're talking about excise tax. Now, there's another one that I just thought of that
Yeah.
is why people do seller financing. What you specifically talked about was a tax, and the term is called progressive. All that means is that as the dollar amount increases, it increases the amount of tax. So if you're looking at, this high up number at the very top, let's just say this is 10 million, that's a higher
Mhm.
tax. If it's here, it's a lower tax, and if it's down here, it's even a lower tax. So by taking it and splitting it, I think you said four, you are now taking one tall thing and making four shorter, right? So brilliant, love it. The other thing there, and this is back to the point on when it comes to excise tax, or I mean, capital gains tax. Most reasons why people want to do seller finance is try to defer or shrink the capital gains tax. Because if that person sold you, let's just say it's 10 million for simple. If they took all that 10 million, and let's say they cost them five to build it, so they netted five. In the state of Washington, I don't know the number, but there's a certain capital gains tax where on top of federal capital gains, the state of Washington has a income uh, tax for that for capital gains. So by spreading it from year one to however many years your deal is, that takes the same, we were just talking about 5 million. If you spread the 5 million over, say, 10 years, now he's at 500,000 a year. So it's decreasing the capital gains tax. Now, in a perfect world, let's just say the capital gains above 500,000 are at the higher rate in Washington. If you got him to, if you're spreading his money back to him, so he's below 500, that incremental state of Washington tax is not applicable. So he saved money on the excise tax, saved money on that incremental state of Washington capital gains tax, which is like 7%, right? So
I don't
every,
even know all this.
oh yeah, I'm gonna look it up right now. Our friends in Washington State think they're better at managing our money. So they love to put these rules in. I want to say it's anything above 250,000, you have to pay an incremental 7%.
Also, a cool strategy outside of the tech stuff, because I'm definitely not the pro on that. I know where I've made mistakes
Mhm.
on the structuring side. So this gentleman wants to break up his tax obligation in the future. One reason he didn't want to do a big deal or two big deals, 6.6 million or two $3.3 million deals, is he wants to break out his realized gain, kind of like you're talking about, over a course of years. So he wants to do one of these notes for 4 years, one for five, one for six, one for seven.
Mhm.
Well, I was thinking, shoot, the 4 year is kind of scary when we're doing such high leverage.
Yeah.
So what if instead of doing like 6% down across the deal, what if we took majority of all of the down payment, put it on one for the
Mhm.
shortest term? So
Yep.
we're basically putting almost 25% down on one and then close to 0% down on the others. So he'd actually have to write a check to close those out,
Uh-huh.
like a small check, like 2 to 3%. But on this one, he'd get a big down payment. And then when it comes time to refinance, already have the equity. So
Right.
that's something cool for deal structuring on portfolios that I'm working on.
Yeah, the other thing you could do, I'm just spitballing with you, is that because he wants to get out of them, you want to take them over. And it sounds like they're in block of four. You could structure to where you're buying one, and then you could do a master lease option with a option to purchase. So you still have control over them, the other three. You actually seller finance the one, and then you'd have a master lease option on the other three. So technically that guy is still the owner of the other three because
Well,
you're doing a
but if
lease.
I can get them seller finance with nothing down for the other three, why wouldn't I just do that?
Yeah, it just depends on how he wants to receive the income related to the tax. So,
Hmm.
um, it could, what you're doing could be optimized. The master lease could be another option. So, but I love these conversations because like I'm learning stuff, right? As you're learning stuff, and I'm hoping like Flavio and Josh and what was it, Mark is on here. So these are all kind of conversations you got to have to be able to, when you actually go to your tax person, be like, hey, my friend was talking about this, where he's doing a seller finance and he's structuring the deal more down on one and less on the others. Is that something that I could do, right? Because at the end of the day, all the stuff that I learned usually came from another investor person, right? Or I watched it on YouTube, quite frankly. I was probably watching Pace more. I was probably watching Cody or somebody else that does these, that has, when you have more stuff, you're going to have to learn about tax. Because the biggest thing is not how much you make, really, it's about how much you're going to be able to keep. So
Right.
this is beautiful stuff where we're talking about how to restructure deals. And really what you're doing there is you're solving this seller's problem. That's why you're getting the deal and not Flavio or me or Mark or anybody else. One, you have the relationship, but two, this guy is, I'm assuming he has a lot of money. He's very comfortable, but he wants to make sure he keeps that money and he stays comfortable, right? So he knows you can operate, solved. But now he's like, well, how do I minimize my tax? So you just brought up the excise thing. You just saved him 80,000 because he's used to doing it one way and you did it this other way. So
Yeah.
kudos to you, right? And you could be like, that 80,000 I just saved you. Why don't we just lower the interest rate? You're like, because you ended up saving him 80K, right?
Yeah, we're not going to lower the interest rate. He's so awesome. I mean, it's just if rates are 12%, he charges 6. If rates are 3%, he charges 6. Like that's just the number. So I
Yeah.
don't ever dare to renegotiate that. It's not worth
Right.
it.
Exactly. And you know what? I had a seller finance deal one time. This was back in 2020. So in the world of sub 4% investor rate, this seller wanted 5.75%. He would not budge. And I'm like, why do you need the 7.5? He's like, I just gotta have it. He was stuck on it. And so then I was like, I could do that, but I mean, that's quite a bit of money. I need to fix up the property. I was able to get I think it was, he wanted 10% down. I ended up getting 3% down, but he still got the 5.75. What for you, your seller is hung
Owner.
up, owner, yes, is wants the 6%. Now, you're giving him exactly what he wants. Why change it if that's the one thing that's the biggest thing? So, because when I'm working with other people, just talking about seller finance, they focus everything about how much money they're going to make. Now, when you give the offer that checks their boxes, the odds of that deal going through are so much higher. So, you've got history. You probably bought from this owner before, right?
Mhm. Yeah, and his whole thing, he gets his price and he gets his interest rate. But
Wow.
I can name the amortization, I can have the interest only, and I can be as flexible as I want with the down payment. So
Mm,
if it's 3% down, 5% down, 10. So basically, if I'm comfortable taking on 6% debt on assets, then I can proceed. And if I'm not, then I don't.
I love it. I love it.
See, it makes it easy to know what to do. And when you do a 6% interest only loan, or if it's amortized, you just have to make sure your cap rate's higher than the rate factor. And
Right.
So on some of these super high leverage deals, it's like the only way to get that deal to work is to self-manage it for a year or two, or
Exactly.
oversee some of the maintenance programs more hands-on.
Right.
But if you can get into a big deal with a low down payment
Hmm.
and you doing more of the work and not really expensive, you're not really paying yourself at that point in time, it can make deals work. And that's not a best practice, but that is part of how I'm making some of these newer ones work right now. And I know long term, I'm going to be really grateful that I did.
Oh, I love it. And I love the what you're talking about here that I don't think gets brought up enough is you're taking calculated bets. I'm assuming you use Excel, right? And you've
Mhm.
run, you're adjusting. You might even have a 50-year AM, right? If just to make it work. You're adjusting
I
these
do
up,
interest only before I do a 50-year AM.
right? So
I don't,
exactly.
yeah,
And you know why? Because you already looked at a 50-year AM versus 0% interest, or I mean interest only.
I'll
So
take
you
zero interest. Yeah.
Yeah. So what I'm getting at is you've done the math. You're not just doing these deals and then hoping it works out. You've done the calculations and you understand it, and now you have a high chance of winning. And in this scenario, you're doing it yourself. So you're betting on yourself to be able to do the deal. And because like every time I'm doing like a meetup or any sort of presentation, they're like, how did you get comfortable with it? How did you do it? It's like you do the math, you do the calculations. At the end of the day, it's only a spreadsheet and it's hypothetical. But based on your experience, it's a calculated risk. And you know if you don't do it, you don't have the potential to get where you want. So I know we were talking about taxes, but that example you just gave needs to be brought up more because so many people would have that same deal and they'd get too nervous. And they'd be
Well, it
like,
doesn't
oh,
work. Yeah, it doesn't work if you third party it. It doesn't work if,
mhm,
you don't participate in the active management of the maintenance, the repairs. Like, it's not gonna work. And there's a lot of people out there that are gonna say that deal is not gonna work. But
mhm.
I mean, that's how I built my portfolio. I was hands-on and I got the costs down to a point where it did work until later it could afford those things because
Mhm.
real estate's a waiting game.
Yeah,
But it's not fun in the beginning. Like I'm not excited about being tight, tighter than I want to be on the debt coverage ratio. Like that's not exciting,
right.
but you do what you have to do.
Yeah. No, and I'm sure, yeah, if you're like me, because I was doing over 100% risk on some, which I'm sure you did too. If you have low to zero down and whatever you bring for the down and you borrowed to get that, and you borrowed to do any, onboarding and transferring the process, you're over 100% leverage. So when I was earlier in the career, I was doing mass risk because like you got to take some calculated risk if you're going to try to get out of the. Now, you never were in the corporate world, so you never were trying to necessarily replace. But for people who are trying to replace, you got to take a lot of this calculated risk to be able to get the opportunity to get out. So, what ends up happening in a perfect world, they all work, but sometimes you're going to have problems. It's just a lot of averages. If you have 100 deals, not all of them, 20 are going to be amazing, 60% are going to be pretty good, and then 20 are going to be, why the hell did I do it? So, over time, you're going to have to do these deals and then find a way to survive at times. And some might be selling them all to restructure things around. But that only helped if you continue to overcome them, which I know you have because you've had good deals, amazing deals, marginal deals, but you're still here. You're still buying, right? Because you've been able to learn from those and as you do more deals, ensure the next deals are better to then right the wrongs that you had in the past.
Oh yeah. So again, yeah. Well, you got to jump off. We can jump into this all day long, but
Hmm.
before you leave, someone mentioned Lucas or Luca said this is for the existing portfolio for newer properties. How does the math look on development? On developments, it has to stand on its own legs. Like I can't take that big of a gamble where I'd have to be hands-on, like doing the GC. Like that doesn't work for me
Mhm.
right now. That risk profile may change, but I'm not rich enough to do that yet. So I'm making sure
Exactly.
that the deals itself have enough margin on that because I can't bail out a development deal.
Exactly. I'm actually my short plat thing. I'm actually meeting with a friend that's a developer. 100% I'm gonna build something, but I could bring him in as a partner. So, and I don't know, I think your deal might already be developed, but you could share some of the money to decrease your risk profile. Because I know what I learned out of my projects, if I'm the sole person driving not the underwriting, but the permitting,
Mhm.
I know for a fact I'm going to cost myself too much money. So I'm never going to be the PM again. So either I got to bring in a partner, or I got to hire somebody to do that specific thing to keep the project on track.
Sweet. Well, with that, we'll wrap up. Thanks for jumping on, everybody. Thanks for hanging around, and we'll see you next week.